All right, I think we can probably go ahead and get started. John, can you hear me?
I can. Can you hear me?
Yep. So this is Mike Murphy over at Ironbeam. I have John Bria here. He's the Director of Client Development and Sales at CME Group. And he's going to take the reins here for a little bit and run through the Micro Crude Oil launch information, and then we'll do a question and answer at the end. If you have a question about one of the specific slides or something, you can ask as we go, as long as it's, has to do with what we're talking about. But anything more general, we can save for the end here, and I'll let John take it away from here.
Cool. Well, thanks, Mike. And thanks, everybody, for tuning in today to talk about Micro Wti Crude Oil Futures. I'm really excited about this product launch. This product in particular has been something that we at the exchange have been working on for years now. And for it to finally be here and come to fruition, and we're a few days away from launch, it kind of feels surreal, but I'm really excited to be here today to talk about it. So we have a lot of stuff to cover, and I want to make sure that I get through this whole deck and leave some time at the end for questions. So getting into it, before we start, we need to go over a disclaimer here at the CME Group. We want to acknowledge that futures trading isn't suitable for all investors, because these products are leverage products, and they each involve the risk of loss. So we always say, before going into any new product or asset class, please ensure that you do all of your research, do all the homework, make sure that you're prepared and you understand how the markets and products work to give yourself that best opportunity to succeed. And if you're looking for any information on futures or CME Group products in particular, you can go to cmegroup.com, and we have an entire educational section there. There's a library of thousands of educational pieces of content for you to go and learn and do some of that research on your own if you're looking for it. Okay, so here's an overview of how we're going to spend our time today. And I've split this up into 4 parts. We're going to start by talking about WTI crude oil background at CME Group, where the CL is trading today and how we got to this point of launching the Micro Crude Oil Future contracts. Part 2, we're going to look into the Micro WTI futures contracts themselves. Part 3, we're going to talk about some of the different ways to trade these contracts. And part 4, I want to highlight some of the oil tools and resources that we have available for free through the CME Group website. Okay, so getting into part 1, WTI crude oil futures background. So what's the story on our current crude oil futures contracts and the options on the futures contracts? So we currently list a standard crude oil contract with the ticker of CL, and we list a mini contract with the ticker of QM. And both of these contracts are among the most liquid and actively traded crude oil contracts in the world. And these contracts, if you're not familiar, they're priced out of Cushing, Oklahoma, and they have deep ties to energy markets all over the world. So we like to say that these contracts, and our products in particular, are the most efficient way to trade on US and international events that are related to crude oil. And as you might be aware, crude oil markets are highly active. They're among the most volatile products that we offer. And so they provide opportunities in nearly all market conditions. So that's something that we believe is really important, because the price is affected by a number of factors directly related to the industry, and they can occur on a macroeconomic level. And with that price action comes trading opportunities. And risk management here is risk management is critical, whether you're in the supply chain or you're investing and just speculative on or using these products to speculate on the price of crude. And something that our products in particular offer is direct exposure to the oil market versus an ETF or a stock for an energy company that has some underlying blend in the product itself. So looking at West Texas Intermediate, let's just spend a brief few minutes talking about what that is. So West Texas Intermediate is a US blend of several streams of domestic light sweet crude oil. The delivery point, like we just discussed, is located in Cushing, Oklahoma, which is home to 90 million barrels of storage. It's more than 3.5 million barrels a day can flow in or out, and more than 3 million barrels a day can flow out. And Cushing is a crucial hub where there is extensive infrastructure that exists and serves as a vibrant trading hub for refiners and suppliers. So just looking at how CL has grown this year. So CL open interest hit a 2-year high of 2.5 million in February of this year, and that's up 10% from January. The CL ADV is a little over $1 million a day, or 1 million contracts a day. That's up 5.7% year over year, month to date. And in 2020, 29% of the futures volume came from non-US regions, and that's up 20% versus, it says 2015, but I think it should have said 2020. And so when you look at that non-US growth, we're seeing it come from EMEA and APEC in particular. I'm going to jump over some crude dynamics because I want to get into the micro contracts. But looking at the price action just this year alone, here's a graph from TradingView. It shows that at the beginning of this year, crude CL was trading around $48 a barrel, and now we're tipping the scale up to, I think it's trading a little over 72 right now, or right around there. So price has appreciated pretty substantially, almost a little over 50% just this year alone. Okay, so that's where I want to spend a majority of our time. Let's talk about the micro WTI crude oil futures that are launching this Sunday. So why are we launching the micro WTI crude oil futures? We're launching these products because there's been a customer demand for smaller, more accessible futures contracts over the last 2.5 years. Since we launched the micro equities back in 2019, the next product that we kept getting demand for was, when are you going to launch a micro crude oil? And so we're finally here. So this product is going to launch this Sunday night on the open. So it's Sunday night, July 11th at 5 p.m. Central Standard Time. Trading will begin. This product will launch for the trade date of July 12th. And we believe that these smaller contracts are going to really resonate with the active individual trader community. But not only with the active individual and the retail community, but we believe that there's going to be a lot of institutional interest on the hedge fund side, on the banking side. So we believe that this product can really resonate with the entire spectrum of traders. So this product, like a majority of our other micro futures contracts, is going to be 1/10 the size of our benchmark WTI futures contract, that CL contract. So it offers the same exposure as CL. It operates the same as CL, but it settles differently than CL. This is going to be a cash settled contract, and we'll dive further into that. So we're going to dive right into the specs here. So looking at the size of this contract, it being 1/10 the size of our standard contract, this micro contract allows the trader to gain exposure to 100 barrels of crude oil. The minimum price tick on this product is a penny per barrel, and the dollar value of one tick is $1 per contract. And the product code is going to be MCL. So CL is the standard contract, QM is the mini, and then we put an M in front of CL to indicate micro crude oil. So the product code is MCL. And then here you'll see the margin requirement on this micro is $530. So that's the exchange margin. The margin might be different at the brokerage firm that you trade through, or it might be different for Ironbeam, but the exchange margin requirement that we're setting it at is $530. And the settlement is financial. So this is going to be a cash settled product. So that's a little different than our standard product, because our standard product is physically settled, as you might know. This is going to be a financially settled product. And the expiration is 1 day prior to the expiration of our WTI crude oil futures contract. So that's 1 day prior to CL, which is a physically settled contract. And then the trading hours on this new contract, it's going to adhere to our normal trading schedule. So trading hours, This MCL will open on Sunday nights at 5 p.m. It will trade through the following Friday, closing at 4 p.m. And each day there's a batch that runs at 4 p.m. So there's a 60-minute trading halt every day where we run our batch. We send all of our trades and positions over to the FCMs, and then trading will commence after that batch is complete. So looking at some of the features that the smaller micro WTI crude oil futures contract can afford. So you see here, you can precisely scale oil exposure with these smaller, more granular products. So we'll go over a scaling example in a few slides, but something that we really like to see and we really like to talk about is the contract's size, and them being 1/10 of a standard contract really allows traders to trade 1, 2, or a handful of contracts at a time, where they're only trading one standard contract. And trading more contracts allows traders to scale in and scale out. You can manage positions with more versatility with these smaller contracts, and you can add access and capital efficiency through these contracts, just the same as our larger, the standard size contracts. These afford the same benefits and features as futures contracts because they are futures. And I want to talk about expiration here, and this is something that I really want to hammer home. So micro WTI crude oil, as we said before, these settle 1 day prior to our standard WTI crude oil contracts. So CL, their trading that product's trading terminates 3 business days prior to the 25th calendar day of the month prior to the contract month. So that's a mouthful right there. So if the 25th calendar day is not a business day, trading terminates 4 business days prior to the 25th calendar day of the month. So remember, MCL is going to expire 1 day prior to that CL contract. And so MCL is cash settled. So you're not going to receive physical crude when this futures expires if you have exposure in it. So there are 2 ways to manage expiration in a cash settled product. And I'm sure most on the call know this, but really want to go over it and highlight that there are 2 options that you have. You can allow, if you have a cash settled position and you're nearing expiration, you can allow that futures contract to expire. If you do allow it to expire, the future will expire and the position will settle into a cash transaction, but you won't have any exposure after that settlement, after that cash transaction is complete. You won't maintain that exposure. So if you wanted to maintain that exposure in crude oil, what you'll do is you would roll your micro crude oil position. You'd roll the futures position. So you'd close out your current position and you'd establish another position in the following month, the next sequential month. And these are monthly contracts. So similar to CL, these are monthly contracts. So if you were trading the August contract and you wanted to maintain exposure into September, you would roll your position from August into that September. And so here's the rolling, here's a chart showing when volumes start shifting from that front month to the next sequential month. And this is something that I really like to talk about with new traders or traders that haven't experienced a roll yet. As you're nearing last trading day, the volume, you'll see here, the volume starts shifting from that front month into that deferred month. And you never want to get stuck in an illiquid market, right? So you want to be cognizant of when that volume starts shifting. So if you wanted to roll your position, you want to get out of your position and establish a new one, you don't want to get stuck in an illiquid market. So right here, there's the graphical representation showing when that volume starts leaving the front month and moving into the next sequential month. The black line here is our Fed contract in CL. You'll see the first half of the month, it's trading, and then volume starts declining near that 3rd week of the month. So when volume starts declining in that black line, you see the blue line, which is the March contract, you see volumes start increasing in that blue contract. So That's indicating that volume is shifting nearing the last trading day. Volume is leaving the Feb contract, rolling into the March contract. Same thing, if now you follow the blue line, same thing here. You're following the blue line, nearing the third week of Feb. Volume starts shifting from the March contract, going over to the April contract. So it's something that you really want to be cognizant of to manage that roll is, when is that volume shifting? Take a look at it and make sure that you shift when that volume shifts, or you roll when that volume shifts, I should say. Okay, so here's our entire suite of WTI crude oil products that we have at CME Group. Remember, we have 3 products. The new product coming out on Monday, or Sunday night's open, is our micro WTI crude oil contracts. We have the E-mini WTI crude oil, and we have the standard WTI. And looking at these, the standard offers exposure to 1,000 barrels. Mini is 500 barrels, so it's half of our standard. And the micro, again, is 1/10. So the micro offers exposure to 100 barrels. The standard is a penny a barrel. The mini is 2.5 cents a barrel. The micro is a penny a barrel. The tick value for each of these, the standard is $10 per tick. The mini is $12.50 per tick, and the micro is $1. The settlement on the micro and mini are both financial, so these are cash settled products. The standard is a physically settled product, and the margin on the micro again is $530. The margin on the mini product is $2,650, and the margin on the standard is $5,300. And again, please remember that the expiration on the micro contract is, you'll see here, it's the same as the mini. So if you're trading the mini today, the micro expiration is the same, and it's going to expire 1 day prior to the expiration on the standard contract. And then trading hours are standard trading hours, Sunday to Friday, 5 p.m. to 4 p.m. with that 1-hour batch. So let's take a look at a few trading examples. So here's an example. You're comparing the P&L of a trader that's trading our WTI crude, our standard contract, that's CL contract, and the P&L of somebody that's trading the micro WTI. Remember, this is 1/10 the size of our standard contract. So 2 traders decide to go long crude. One executes on CL, one executes on NCL. Both traders go long. One August contract, $74. So here's an example of how the P&L fluctuates. So on the first day, T+1, these traders, the August contract is at $74.50. So their position appreciates by 50 cents. That's a $50 profit for the micro trader, $500 profit for the standard trader. T+2, crude's trading at $75.63. That's a $1.63 profit for, $163 profit for the micro trader, $1,630 profit for the CL trader. And so at the end of T+3, so I'm not going to go through that T+3 example. I think everyone gets the point. At the end of this trade, the traders, 3 days after they place a trade, they want to offset their trade. They want to close out. Crude's trading at $75.23. P&L for that standard trader, they would have profited $1,230. The P&L, the profit for that micro trader, they would profit $123. So remember, micro crude is 1/10 of our standard. The margin on crude is $530. The margin on the standard is $5,300. So here's a simple example of a P&L for both those contracts. So, okay, looking at scaling, this is something that, we talked about it before, micros have really allowed traders, especially on the retail side, to start scaling in and out of positions. some traders may have only been trading one standard CL contract. They might be able to, if they would like, to trade a handful of micro CL contracts. So when you're trading more than one contract, you gain the ability to scale in or scale out. And here's an example. So this trader goes long 5 micro CL contracts at a little over $73, right? So that price starts appreciating. They're long 5 contracts. The price appreciates to a little over $74. This trader now wants to lock in some of that profit. Whereas they were trading just one contract, they would have to close out their entire position to lock in that profit. But since this trader has 5 contracts, they want to sell just 3 of those contracts. So they sell 3 at $74.50, locking in a profit, but they're maintaining that position and maintaining the exposure to crude oil. So they still have a position of 2 contracts left. That price starts appreciating some more. Now it's over $75. $75 a barrel. They want to close out one more contract, maintaining that long exposure still with one contract. So in this example, crude soars to a little over $76 a barrel. They close out their entire position. So in this example, this trader was long 5. They sold 3 at a certain level. They maintained that exposure. They let their profits rise to a higher level. They sell 1. They maintain an exposure of one last contract, and they let it soar to a higher level there. And then they finally close out. And this is an example of scaling out, but you can also scale in. If a price starts depreciating and you believe that it's going to continue to depreciate, you might put on one contract at a certain level. And the price continues depreciating, you might scale in again, you might put another contract on at a certain level. So it works both ways. And something that we really have seen a lot of, especially from the retail community, is scaling since the launch of our micro equity contracts back in 2019. Okay, so let's take a quick look at our standard crude oil contract versus the major energy ETFs. So our crude oil futures alone have a daily average notional dollar value traded greater than all 5 of the major ETFs combined. So we like to say that our CL contract is one of the most liquid futures contracts in the world, and it's one of the largest futures contracts in the world. When you look at the average daily volume that CL does, we do $33.5 billion. That's average daily dollar volume. So that's $33.5 billion. And then you compare it to the energy sector ETF, they do $1.15 billion. The US oil ETF, USO, only does $153 million. The AMLP ETF does $82 million. Vanguard ETF does $51 million. And so when you take a look at the CL contract and futures in general, and when you look at and you compare them to the ETFs, there are a lot of advantages that futures offers that ETFs don't. So futures offer 24-hour trading. Futures offers 60/40 tax treatment. Futures offers capital efficiency, because typically the margin that you have to post is somewhere around 3 to 7% of the notional versus 50% reg team margin on stocks and ETFs. So the data for this was collected back in the 4th quarter of 2020. It's still in the same range of this. And it's pretty, to me, I like looking at these numbers because it puts into perspective just how large the CL market is. And we believe from all of our broker feedback and our client feedback that MCL is going to be a very popular product. As I said before, not only in the retail community, but institutionally as well. Hedge funds, banks, props, everybody is excited for this product launch. We believe that the volume and liquidity should be there right out of the gate. So we're really excited for Sunday night. Okay, so here's a slide on getting short energy. So you can short futures just as easy as you can go long. You can't short stock or ETF as easy as you can short futures. So here's an example of how one can short or express a short opinion on crude oil with micro futures versus Exxon versus Schlumberger versus the Select Energy ETF. If somebody wanted to go short one micro contract, that would offer them notional exposure of, if crude's trading at $74 a barrel, offer them notional exposure at $7,400 just for one contract. That trader would have to post $530. That's the margin requirement on it. Price decline from high to low. Price decline from high to low, $75 to $63.75. That's a 15% price decline. The profit on that trade is $1,125. When you compare that to the ETF and stock, those traders would have to post 50% margin, so they'd have to post $3,700 to take the same position, same exposure. And their profits, if you see for a 15% decline, their profit on the trade is right around the same profit as the futures, at a little over $1,100, but they don't have the capital efficiency on the ETF and stock side, because you do have to post that $3,700 versus the $530. Okay, so I wanted to highlight one of the tools that we have here at CME Group, and that is our OPEC Watch tool. So we have an OPEC Watch tool that is free to anybody that wants to go and use it. It's located on cmegroup.com. If you search OPEC Watch tool, you'll get the link and you can go right into it. And what it does, it calculates the probability of potential outcomes from the next OPEC meeting. So it uses the CL option market price, and it calculates the implied probabilities of the OPEC event outcomes. And we categorize the three outcomes into three very simple categories. The first is increase output, the second is maintain output cuts, and the third is further output cuts. And then the tool actually assigns a probability to each one of those outcomes. So here's a screenshot showing an outcome probability as of July 1st. And this is they're on the left-hand side here of this picture, you'll see 5 different views: current, history, option open interest, data, and COT. So this is the current view right now. And this is as of July 1st. You see July 1st OPEC meeting outcome probability, 84% probability of further output cuts. So this tool, based on the CL market data, the CL options data, is calculating an 84% probability of further output cuts. And looking at the history, you can actually dive in. If you wanted to go back and do some research, you can dive in to history of this tool. So if you see at the top, there are all these different tabs: July 1st, June 1st, April 28th. If you wanted to go and play around with this, you can go back in and you can see the probability history dating back to the certain dates that we have located, or certain dates that we have listed, I should say, in this tool. And so with this tool, it can help those that are managing energy price risk by showing the probability of potential outcomes. It could help any investor or trader that's in the CL or MCL markets. The tool can be an indicator for potential changes in supply in the physical markets. So whether you're a hedger, speculator, or spreader, you can click this link. I'll provide Mike with this deck, and Mike will be able to circulate it. So you can click this link if you're interested in the tool to go play around with it. And then we also have a lot of key reports that are available as well. And so all these reports we feel are really helpful to traders that are trading the energy markets. So you see we have 9 reports here. These are all clickable links as well. So if you wanted to play around with it, through the deck, you can click these links. It will take you directly to the page on cmegroup.com where these reports live. So you see here, you have the Energy Information Administration, you have the American Petroleum Institute. There's a ton of information, a ton of reports that we offer, and we really encourage people to go and check them out, especially if they're trading crude oil regularly. And then on top of the reports, we have more tools. We have tools such as, we have a Commitment to Trader tool, we have that watch tool that we just talked about. We have price action alerts. And so if you're interested in subscribing to some of those price action alerts for MCL, you can do so through that tool. We have a liquidity tool. So we have a ton of tools and a ton of resources available through cmegroup.com. And with Micro Crude coming out, especially people that may not have traded the crude oil, the standard CL contract, and you're getting into crude oil for the first time through MCL, I'd really encourage you guys to go take a look at the tools and the resources that we have available, so you have a good understanding of how those markets work and the fundamentals behind them. It looks like we're at it. We muscled through that pretty quickly. So we have a lot of time for questions here.
Looks like we have a couple in here. First one is, what are the exchange fees for MCL, and are they also a tenth of CL? I believe the exchange fee is 50 cents a side, and MCL is it is 1/10 the size of CL.
The exchange fee on MCL, we're setting it at 50 cents. You're correct. 50 cents a side on MCL.
And the next question, CL went negative last year. What changes, if any, have been instituted to keep CL traders safe since then?
It's a very good question. We at the exchange like to say we're going to let the market go where it needs to go. And when crude oil went negative last year, we let it go there because that's where the market took it. MCL is going to operate the same as CL. And if it goes negative and if the market dictates that that's where it should trade, MCL is going to operate in the same fashion as CL did last year.
And I think I agree with that. I think if anything, it's you're more protecting people that way than instituting some sort of price limit on the low side. Because then you're kind of, it's not really a free market. The price discovery is not really real if you say it can't go below a certain price,
Exactly right.
Someone asked if we can give an example of the options on the micro, but I don't think it's launching with options just yet, correct?
So it's not launching with options yet. So the way that we the whole product process is we launch with a futures product. And once we build liquidity and we have enough interest in that product, interest in terms of volume, in terms of open interest, in terms of number of traders trading the product, once we see that build and we think that it's at a certain level, we don't have a standard level, but once we see that it's at a level that we're comfortable with, then we'll look into introducing options. So we're launching with the futures. If this builds quickly, we'll be looking to introduce options at some point.
Next question, what is CME doing to ensure liquidity in MCL? Are you bringing on any market makers or anything like that for the launch?
Yeah, and that's a really great question. It's very important. So thanks for asking that, because we are employing market makers for this contract. And we have market makers signed up for US hours and extended trading hours. So market makers will be there around the clock on day one. And this product in particular gained a lot of interest from the prop community. And we're very pleased with the interest from our market makers. So we're expecting liquidity to be there and pricing to be on the screen on Sunday night.
Next question is, you said that futures offer 60/40 tax treatment. What does that mean? I'm assuming he is talking about Section 1256 contracts. So when you trade futures, it's not like trading stocks where, depending on how long you hold it, you're either taxed short or long-term capital gains. With futures, 60% is taxed at the long-term capital gains rate and 40% is taxed at short-term capital gains. I don't know if you have anything to add to that, but I'm assuming that's what he's asking about there.
No, you're exactly right. That's what I was talking about.
Next question, are there weekly options on MCL? Nope, there's no options yet. I think we just covered that, but I'm sure there will be eventually. I don't see there being any liquidity problems with this contract given the amount of interest we've had so far on it.
Yeah. And to expand on the interest part, that's been one of the coolest parts about this launch is that, Mike, as you know, we've had interest in this product for years, and we've been working on this product for years. And we're really excited because for years we've had people tell us, you need to launch this product. It's finally coming to fruition. And I don't think we've seen like enthusiasm for this product. This product has seen more enthusiasm than I even believe that the equities did back in 2019. So we're excited.
We'll give you guys a couple minutes here. That was the last question, at least in the queue, but if you guys have anything else, we're happy to cover them. Matt had a question about the exchange fees. Yes, the CL is a tenth of the size. The exchange fee is not a tenth of the size. If you look at some of the other micro products, like MES versus ES, the contract size is 1/10, but the exchange fees aren't exact. Because the cost to clear stuff isn't, it's not like if we create a smaller contract, the cost to clear it's a tenth. But yeah, you're correct. The MCL exchange fee is 50 cents. CL exchange fee is $1.50. This question's probably more for you, John. Jim's asking what percent of the major brokers are supporting the launch with the ability to trade it in their platforms.
Right now, as of today, all of our retail brokerage partners in the United States have indicated that they will be there either day one or week one. So that's 100% of the retail brokers that we have a direct relationship with at CME Group telling us that they're interested in this product. They want to list it either day one or week one. Typically, what we see with new product launches is that retail brokers will watch that launch as soon as it goes live on Sunday night. If they see that the market is to their standards in terms of liquidity and bid-ask spread tightness, then they'll turn it on. So we anticipate that to be pretty quick, but we're really enthusiastic because everybody has said that they're here in the States, at least, has said that they're ready and willing to turn it on as soon as this product meets their expectations, the standards that they set.
And obviously here at Ironbeam, we're going to be offering it day one, at least on the Firetip platform. As long as CQG and Rhythmic have it ready in their systems, it'll be available day one there as well. Someone is asking, how do we expect the volume to compare to the Nasdaq? I'm not sure personally. Those are kind of unrelated products to each other. But if John, if you have any thoughts on that.
That's a tough one to answer. They are unrelated. I would assume they're maybe referencing the mini net or the micro Nasdaq. But in terms of volume and participation, I would assume this micro contract will attract similar volume and participation, but that's just pure speculation.
Next question is, what is a good proxy stock to follow for the MCL, not an ETF? I would not know. We just specialize in straight futures, so that might be something you can find in the forums or something like that. But I don't have an answer for you there. The next question is, what is the minimum investment? So for MCL, what was the initial margin there? 550 or something like that, John?
530.
530. So
530.
The minimum you would need to buy MCL and hold it overnight would be 530. If you're looking to day trade it, it would be a good amount lower, probably somewhere between $50 and $100 per contract for day margin. But if you're going to hold it through the close and position trade it, you'd be looking at 530 a contract. Then Jim asked, for Ironbeam, what offerings are there to trade MCL on a mobile app? The FireTipX mobile app is awesome. I personally think it's the best futures trading mobile app. So if you're looking for a mobile solution to trade MCL or any futures really, the FireTipX mobile app is pretty great. William asked, how wide will the spreads be? I don't imagine they're going to be very wide. They're probably going to be very similar to the CL contract. You know, if there's not a ton of trading volume, which I think there will be, the market makers will keep the spreads pretty tight, but I don't even know if it's going to be something that they're going to have to do. I don't know if John, if you have anything to add there, but I would assume they're going to be pretty much the same as the regular CL.
Yeah, that's our goal. Our goal is to make sure, or our goal is for this micro contract to mirror the bid ask of the CL. We always aim for a one tick wide market, right? So that's what we're going to be, that's the goal, and that's what we'll be working towards.
And George here is, he's looking at a WTI chart, which I take it is some sort of crude oil stock chart. And he's asking, he says, I assume one must decide where the price will go over a period. And as such, this is similar to a stock. So yeah, in terms of buying and selling and all that stuff, futures are the same as stocks, you know, buy low, sell higher to make money or vice versa. You probably, it's a little tough to cover in a webinar, but if you just do a little research on futures, they're very similar to trading anything else, really. I could probably spend an hour explaining the difference between futures and stocks, but I just don't think we have time here, unfortunately.
One thing to expand on that, Mike, is something we like to say at the CME. When you're trading crude oil, crude is a contract that is really affected by supply and demand. You really see outbreaks when there's an OPEC meeting about supply and demand, or you see a headline about supply and demand. So when you're looking at those charts and those graphs, also look at some of those reports that we touched on that are available through cmegroup.com on where the global supply and demand is and at any given time, and what the US is doing, what Russia is doing, what Saudi Arabia is doing. There's a ton of information out there. So that's just my 2 cents on that question.
Yeah, and especially with crude, the nice thing about crude is that you have weekly supply reports. The biggest one is it's been a while since I've traded crude, but it used to be Wednesdays at 9:30 a.m. from the EIA. I'm going to assume it's still the same time, but if you're looking to start trading crude oil, you know, that'd be a good place to start. And Mr. Bello is asking, what is the name of the mobile app again? It's called FireTipX. So if you just search in the Android App Store or iPhone App Store, Just search FireTipX and you can download it. If you don't already have an account with us, you're going to need a login to go in there. So if you go to ironbeam.com and click on FireTip up at the top, it's the first tab. You can sign up for a 2-week demo, or you can just, open a live account and get free access to the platform as well. Raymond is asking if MBO data is available on CL and MCL. I know for a fact it's available on CL, so I'm going to assume it's available on, or will be available on MCL as well. John, do you know anything about that?
Yeah, it will. It will be available on MCL once it launches.
Is MBO available on all futures, or do you guys limit it only to certain products?
I don't think we limit it at all. I think that it's available on everything, but I'll confirm that. But I've never heard us limiting it.
I know some platforms and data providers, I think they're the ones that limit it. I think providing that data puts a good amount of strain on the servers because it's a lot more information they're processing. So I think they just pick products where their users are requesting MBO data for, and they enable it for those, and the rest they probably don't provide it for. And I think that is the last of the questions. If you have anything else, feel free to put it in there. We'll probably give it 30 seconds or so, and if we don't get any new questions, we'll wrap it up here. But thank you for everyone for coming out. Thanks to John, and we'll just see here if we have a couple more pop in. Yes, Ray, this is being recorded. We'll put this up on the Ironbeam YouTube channel, and then we'll also email this out to anyone that attended, so you'll be able to play it back. All right, I think that does it. John, do you have anything else?
Nothing else from my side. I just appreciate you guys allowing me to be here today to talk about this product, and looking forward to Sunday night.
Yeah, absolutely. I'm excited too. I think you're right. We had a good amount of interest for the micro E-mini S&P and stuff, but I think the idea of micros was new to a lot of traders, and now that the micro S&P and stuff did so well, I think it's kind of a snowball effect, and everyone's really excited for the crude oil launch. So I think it'll be great. And thanks everyone for coming out. Thanks again, John, and we'll see you next time.